Right now, somewhere in America, someone just like you is sitting on $10,000. Maybe it's in a savings account earning almost nothing. Maybe it's in a checking account slowly losing value to inflation. But here's the thing. What if you took that same $10,000 and dropped it into three of the best Fidelity index funds available right now? Not some exotic strategy, not some guru's secret pick. Just three simple, boring, wildly effective index funds that millions of Americans already use to build serious wealth. That's exactly what we're breaking down today. And by the end of this video, you're going to see real numbers, real returns, and a real strategy you can copy before you finish your coffee. Let's get into it. The three funds we're talking about are FXAIX, which is the Fidelity 500 Index Fund, FSKAX, the Fidelity Total Market Index Fund, and FXNAX, the Fidelity U.S. Bond Index Fund. These aren't trendy, they're not flashy, but together they form the kind of portfolio that quietly turns regular people into future millionaires. Let's start with the heavyweight. FXAIX tracks the S&P 500, which means when you buy this fund, you instantly own a piece of Apple, Microsoft, Amazon, Nvidia, and about 496 other of the biggest companies in the United States. This fund holds over $752 billion in total assets. It's one of the largest mutual funds on the planet, and it charges you an expense ratio of just 0.015%. For every $10,000 you invest, you pay about $1.50 per year in fees. Compare that to the average mutual fund, charging around 0.72%. That difference alone could save you tens of thousands of dollars over a lifetime. Now the returns. Over the last 10 years, FXAIX has delivered an average annual return of roughly 15.56%. In 2023 alone, it returned over 26%. In 2024, another 25%. Even after the brutal 2022 downturn of negative 18%, the fund bounced back hard and kept climbing. If you had invested $10,000 in FXAIX 10 years ago and just left it alone, that money would have grown to approximately $42,800. Next up, FSKAX. This is Fidelity's Total Market Index Fund, and it goes wider than the S&P 500. Instead of just the 500 largest companies, FSKAX holds roughly 3,800 stocks across large-cap, mid-cap, and small-cap companies. So, you're getting exposure to the entire U.S. stock market in a single fund. It's like buying a slice of the whole American economy. The expense ratio here is also just 0.015%. The total assets sit around $125 billion, and the 10-year average annual return is approximately 15.08%. Slightly lower than FXAIX, and that's because small and mid-cap stocks don't always keep up with the largest companies during mega-cap rallies. But here's the trade-off. In years when smaller companies outperform, FSKAX gives you that upside too. In 2020, for example, FSKAX returned 20.78%, beating FXAIX's 18.39%. That extra diversification matters. If you invested $10,000 into FSKAX 10 years ago, you'd be looking at roughly $41,200 today. Again, no genius moves required, just consistency and patience. Now let's talk about the stabilizer. FXNAX, the Fidelity U.S. Bond Index Fund, tracks the Bloomberg U.S. Aggregate Bond Index. This fund holds government bonds, corporate bonds, and mortgage-backed securities. It's not here to make you rich overnight. It's here to protect your portfolio when stocks take a hit. FXNAX has an expense ratio of 0.025% and holds about $68 billion in total assets. The returns are obviously lower than stocks. Over the last 10 years, it's averaged around 1.5% to 2% annually, largely dragged down by the historic 2022 bond crash of negative 13%. But last year, bonds bounced back with a 7.13% return, and the fund currently offers a 30-day yield of roughly 4.13%, which means it's paying you income just for holding it. If you put $10,000 into FXNAX 10 years ago, you'd have approximately $11,700. Not exciting on its own, right? But here's why it matters. In 2022, while FXAIX dropped 18% and FSKAX dropped nearly 20%, your bond allocation would have softened the blow significantly. Bonds are the seatbelt of your portfolio. You don't notice them until the crash. But what happens when you combine all three? Let's say you split $10,000 across these funds. You put 50% into FXAIX, 30% into FSKAX, and 20% into FXNAX. That's $5,000 in the S&P 500, $3,000 across the total market, and $2,000 in bonds. A classic growth with stability approach. Based on the historical 10-year returns, your FXAIX portion would have grown to roughly $21,400. Your FSKAX portion to about $12,360. And your FXNAX portion to around $2,340. That brings your total portfolio to approximately $36,100. You turned $10,000 into over $36,000. And you did it without picking a single stock, without watching CNBC every day, and without paying some advisor 1% of your portfolio every year. But the real magic is what happens when you don't stop at $10,000. If you invested that initial amount and then added just $200 per month into this same three-fund split over those 10 years, your total portfolio would be in the range of $85,000 to $90,000. Stretch that out to 20 or 30 years with consistent contributions, and you're looking at generational wealth built on autopilot. Here's what most people get wrong, though. They wait. They wait for the perfect moment. They wait until they understand everything. They wait until the market dips. But the data proves over and over again that time in the market crushes timing the market. Every single time. The person who invested $10,000 10 years ago and forgot about it beat the person who spent 10 years waiting for the perfect entry point. And here's the best part. You can open a Fidelity account today with $0 minimum. These three funds have no minimum investment. You can start with $100. You can start with $50. You can set up automatic investing and let the system do the work while you focus on living your life. This isn't complicated. It's not supposed to be. The wealth-building game was never about being the smartest person in the room. It's about being the most consistent. It's about starting before you're ready. It's about letting three boring index funds do the heavy lifting, while compound interest works around the clock for you. So, if you've been sitting on cash, waiting for a sign, this is it. Pick your funds, set your contributions, and let time do what time does best. If this breakdown gave you clarity, hit that subscribe button. And if someone you care about needs to hear this, send it to them. Thanks for watching, and I'll see you in the next one.